Welcome back. Now, in this lecture, we'll see what is a future contract, and in the next lecture, we'll look at what are options. So, let's start with what is a future contract. Now, a future contract is essentially a derivative instrument, or in simple words, it is a financial contract between two parties. Now, one of the parties in this contract is the buyer, and the other party is the seller. Now, by entering into this contract, the two parties agree to transact a financial instrument. This financial instrument may be a stock or a bond, or alternatively, they may agree to transact a physical commodity for future delivery at a particular price. Now, while this definition mentions that the contract is for delivery of a financial instrument or commodity, it should be understood that the delivery is optional, and in fact, most of the contracts do not end up in delivery of securities or commodity, but are actually settled by the way of cash. Now, let's look at this and the fundamentals of future markets in greater detail. Now, a future contract is a contract traded on exchanges, just like a stock is traded. Essentially, buyers and sellers place their bid prices and offer prices, and the exchange electronically matches this order and executes trade. So, as far as actually executing trades in these contracts is concerned, it is not very different from what you are doing with stocks. What is different though is the nature of what you are buying or selling. So, to understand the underlying concept of future, let's take an example. Let's say a bread maker enters a contract with a farmer for supply of grains at a fixed price at the end of the month. Now, the farmer is obliged to deliver him the grains at the end of the month, and the buyer will pay him the fixed price decided in the contract at the time of initiation of the contract. Now, if during the period from the time the contract was initiated to the time the delivery has to happen, now if during this period the price of the grain goes up, the buyer of this contract is insulated from the change in price, and this is essentially the essence of a future contract, and this is how it works in case of a commodity future contract. Now, in case of stocks, just the delivery of grains is replaced by delivery of stocks, where the buyer of the contract is insulated from an increase in the price of the stock during the period. Since the future contract is a legal contract, everything is essentially specified in a standardized way in the contract. The exchange essentially specifies the details of the contract. In case of stock futures, the exchange specifies the name of the stock to be delivered, the quantity of the stock to be delivered, and the date at which the stock has to be delivered. Now, we said before that it is not necessary that there may be actual delivery of stocks or commodities at the expiry of the contract. This is so because there is an alternative to delivering the stock or commodity, which is known as cash settlement. Let's understand the concept of cash settlement using an example. If a future contract on a stock is entered between a buyer and a seller at a price of 10, whereby at the end of the month the buyer agrees to buy 1000 stocks from the seller at a price of $10. Now, if at the end of the month the value of the stock goes up to 11, the buyer has benefited from the contract since he is essentially buying a stock at 10 and the same stock is trading at 11 in the market. So, from a buyer's perspective, if he were to immediately take delivery of the stock and sell in the market, he will make a profit of $1 on each stock. On the other hand, the seller of the contract is essentially at a loss from this contract since he is essentially selling a stock at 10 when the same stock is trading at 11 in the market now. If he wouldn't have entered this contract, he could have sold the same stock in the market at 11. So he is essentially making a loss of $1 on each stock as part of the contract. This is the case if he already owns the stock that he has to deliver. But if he does not already own the 1000 stocks that he needs to deliver as part of the contract, he will need to buy the stock at 11 from the market and sell it to the buyer of the future contract at 10. So he'll be incurring a loss of $1 on each stock. By performing all these actions, the seller of the stock is essentially losing $1 on each stock, or a net of $1 multiplied by 1000, which is around $1000. That is his loss on the contract. While in case of the buyer, by taking the delivery in the contract and selling the stock in the market, the buyer is essentially gaining $1 on each stock, or a net of 1000 into $1, which is $1000 in the contract. Now, the easier way for both parties, which avoids all these cumbersome activities, is to essentially exchange this $1000 amount, whereby the seller directly pays to the buyer the sum he is losing on the contract. So he need not buy from the market and deliver to the buyer, and the buyer need not take the delivery from the seller and go to the market and sell these 1000 stocks in order to realize his profits. So essentially, they can just exchange this sum of money, and this is what is known as cash settlement of futures contract. And the fact is, this is how most contracts are actually settled in the market. When it comes to actually trading the futures contract in stocks, we already discussed how by using futures contract, you can implement the same view on a particular stock with lesser money. But as we have already mentioned, this is a double-edged sword, as both your losses and profits are magnified due to leverage. Now in the next lecture, we are going to look at options, which is another popular derivative instrument.